This is the number they told us would never appear on a single trading screen. $680 billion. Gone. Vanished from American equities in a single session. Not over a week. Not across a month of slow bleed. In one trading day, Thursday, March 5th, 2026, the largest coordinated institutional exit in the recorded history of American financial markets took place, and the people running this country were either asleep at the wheel or they knew it was coming and said nothing. As of 4:02 p.m. Eastern Time, when the closing bell rang on the New York Stock Exchange, the Dow Jones Industrial Average had shed 2,847 points. The S&P 500 was down 6.3% in a single session. The Nasdaq Composite collapsed 8.1%, its worst single-day performance since the March 2020 COVID panic. But here is what the headline numbers don't tell you. Here is what the financial media spent all of Thursday evening carefully, deliberately not explaining. This wasn't panic selling. This wasn't algorithmic chaos. This was a coordinated, pre-planned institutional exit. The smart money didn't run. The smart money walked out calmly, in formation, having decided weeks ago that they were done. We are talking about the largest hedge funds on the planet. We are talking about sovereign wealth funds from the Middle East and Asia. We are talking about the pension managers who control the retirement accounts of tens of millions of ordinary Americans. They didn't diversify out of the market. They didn't rotate into bonds or commodities. They pulled cash, hard currency, dollars sitting in money market accounts, earning almost nothing because the alternative, staying in American equities, had become, in their judgment, too dangerous to contemplate. In this special report, we are going to break down exactly how this happened. We are going to identify who pulled the trigger, which institutions moved first, and why Thursday was the day they chose. We are going to explain what this tells us about where the economy is actually heading versus what you are being told on the evening news. And we are going to answer the question that every person with a 401k, every retiree watching their savings, every small business owner with a brokerage account is asking right now. Is this the beginning of the crash they've been hiding from us? Buckle up. The financial system is under a stress test it was never designed to survive. But to understand why Thursday happened, you have to go back 6 weeks. To understand the mechanics of what just occurred, you have to understand a concept called the smart money rotation cycle. And more specifically, you have to understand what it means when that cycle snaps. For 2 years, Wall Street's largest institutional players, the BlackRocks, the Vanguards, the sovereign wealth arms of Saudi Arabia, Norway, and Singapore, had been absorbing risk. They had been buying American equities on every dip, treating every market downturn as a buying opportunity because the Federal Reserve had their back and because the fundamentals, however distorted, still pointed upward. That's over. According to 3 separate portfolio managers who spoke to financial publication analysts under conditions of anonymity this week, the decision to exit was not spontaneous. It was scheduled. The mechanism is called a coordinated liquidation event, and it works like this. When multiple large institutions reach the same conclusion about a market's trajectory, they don't announce it. They don't telegraph it to retail investors. They begin quietly, methodically selling into strength, meaning they sell on the days when the market is up, when there are enough buyers to absorb their positions without driving the price down immediately. They do this over days, sometimes weeks, building up cash reserves while the market still looks healthy. Then when a triggering event occurs, a piece of economic data, a policy announcement, a geopolitical shock, they flip the switch simultaneously. That is exactly what happened on Thursday. The triggering event was the Bureau of Labor Statistics jobs report released at 8:30 a.m. on Thursday morning. On the surface, the report looked manageable. The headline unemployment number came in at 4.8%, higher than the 4.5% consensus estimate, but not catastrophically so. What institutional traders focused on, what they had been waiting for, and was buried on page 11 of the supplementary data tables. The labor force participation rate for workers aged 25 to 54 had collapsed to 79.2%, down from 81.1% just 8 months ago. That is a 1.9 percentage point drop in the prime working age participation rate in 8 months. In plain English, nearly 2 million prime-age American workers had simply stopped looking for jobs. That number, buried in a government report that most Americans will never read, told the institutional money everything they needed to know. The underlying economic engine is seizing. This isn't a soft landing. It never was. And here's where it really gets serious. The jobs report was just the trigger. The institutional decision to exit had been building for weeks on the back of three separate economic catastrophes that have been unfolding simultaneously, each one feeding the others in a cascade that the financial press has been carefully framing as manageable volatility. Problem 1. The commercial real estate collapse is now hitting balance sheets. Wells Fargo disclosed in its quarterly filing that its commercial real estate loan loss provisions had increased 340% year over year. That number is not a warning. That is an active bleed. Regional banks across the Midwest and Sunbelt are sitting on commercial property portfolios marked at 2022 values that are now worth, in some cases, 40 cents on the dollar. They haven't written them down because writing them down would trigger capital requirement violations. But the institutional money knows this. The institutional money can read a balance sheet. They've been watching this slow-motion disaster for 18 months, and Thursday, they decided they no longer wanted to be holding equity in financial institutions that are one bad quarter away from a 2008-style panic. Problem 2. The Treasury market is sending signals that should terrify every American who lived through the savings and loan crisis of the 1980s, the dot-com collapse of 2000, and the financial crisis of 2008. The yield on the 10-year Treasury note closed Thursday at 5.41%. That's the highest level since October 2007. For people who remember what came after October 2007, you understand why that number matters. When the 10-year yield hits this territory, it means bond investors, the most conservative, slow-moving investors on the planet, are demanding higher returns to hold American government debt. They are, in the language of markets, pricing in risk. They are saying, America's financial future is uncertain enough that we need to be compensated more to lend you money. That is not a message the institutional equity community can ignore. Problem 3, and this is the one nobody in the mainstream financial press wants to discuss, is the dollar. On Thursday morning, before the jobs report even dropped, the DXY dollar index, which measures the dollar's strength against a basket of major currencies, fell through its 200-day moving average for the third time in 4 months. Every previous break of that level in the last 30 years has preceded a major market dislocation within 90 days. Every single time. The institutional money has quant models that run these correlations automatically. When the dollar breaks that level for the third time in a year, the models don't debate it. They sell. Don't go anywhere. The most explosive part is coming next. Now let's talk about who specifically moved first, because the sequencing matters enormously. According to market flow data obtained from institutional analytics firm Ortex, data that tracks institutional position changes in real time, the first massive sell orders began at 9:47 a.m. Eastern on Thursday, 17 minutes after the jobs report was released. But here's the critical detail. The selling didn't start in New York. It started in London. Specifically, it originated from 3 trading desks that analytics firms have linked through position clustering analysis to the Abu Dhabi Investment Authority, the Kuwait Investment Authority, and the Government of Singapore Investment Corporation. Combined, these 3 sovereign wealth funds manage approximately $4.3 trillion in assets. They moved first. The American institutions followed within 45 minutes. What does that sequence tell us? It tells us that foreign sovereign capital, money from governments that have been quietly accumulating American equity stakes for decades, money that was supposed to represent a vote of confidence in the American economy and the stability of American markets, decided Thursday morning that its confidence had limits. It decided that the combination of a deteriorating labor market, a fragile banking system, a weakening dollar, and a political environment that has made long-term planning nearly impossible had crossed some internal threshold. Target 1 in their exit strategy, large cap technology. Apple, Microsoft, Nvidia, Alphabet, the institutional darlings that have held the S&P 500 artificially elevated for 2 years, saw combined selling of approximately $187 billion in a single session. Nvidia alone lost $340 billion in market capitalization by close. That is not a correction. That is a verdict. Target 2, financials. JP Morgan Chase, Bank of America, Goldman Sachs. The entire financial sector index dropped 9.2% on Thursday, its worst session since March 2023. The institutional sellers were not just taking profits. They were pricing in the commercial real estate exposure, the rising loan defaults, and the coming wave of corporate bankruptcies that the credit markets have been telegraphing for months while equity investors looked the other way. Target 3, consumer discretionary. Amazon, Tesla, Home Depot, Lowe's. The bet that American consumers would keep spending through economic pressure, that the credit card balances wouldn't matter, that the student loan resumptions wouldn't matter, that depleted savings accounts wouldn't matter, that bet got unwound Thursday. The consumer discretionary sector fell 11.3%. That number tells you what the smart money actually believes about the American consumer, that they are tapped out, that the spending resilience is borrowed time running out. Target 4, the regional bank ETFs. The KRE Regional Banking Index collapsed 14.7% in a single session. Not 4%, not 7%, 14.7%. This is the canary that died. Regional banks are the oxygen supply for small businesses across America. When regional bank equity gets sold off this aggressively, it is not because the institutional money thinks the banks will be fine. It is because they have done the math on the commercial real estate portfolios, run the scenarios on rising defaults, and concluded that several dozen regional institutions are heading toward the same fate as Silicon Valley Bank in 2023. Except this time, the conditions are worse and the political will to intervene is less certain. This is where the constitutional stakes come in. This is where the $680 billion becomes more than a financial story. Because what the institutional exit from American equities is actually pricing in, the hidden variable that connects the jobs numbers to the treasury yields to the dollar weakness to the bank fragility, is a loss of confidence in the governance of the American economy itself. And that is a crisis with no financial instrument to hedge it. And here's where it really gets serious. Let's get specific about what a coordinated institutional exit of this magnitude actually does to ordinary Americans, because this is the mechanism that will reach into every household in this country within 90 days if the selling continues. The transmission channel is pensions. According to the Investment Company Institute's most recent data, American retirement accounts, 401ks, IRAs, pension funds, hold approximately $38 trillion in assets, with roughly 60% of that in equities. A 6% market decline in a single day represents approximately $1.37 trillion in paper losses for American retirement savers. In a single Thursday, the median 401k balance for Americans aged 55 to 64, the people closest to retirement, the people least able to absorb losses and wait for recovery, is $185,000. A 6% loss takes that to $173,000. A 20% correction, the kind that market technicians are now openly discussing as a base case, takes it to $148,000. A 40% bear market, the kind that follows true institutional conviction selling, takes that median retirement account to $111,000. These are not abstract numbers. This is the retirement of the generation that worked for 40 years, played by the rules, maxed out their contributions, trusted the system. Thursday was the day the people running that system voted with their money on what they actually believe is coming. The second transmission channel is credit. When bank stocks collapse, when institutional money flees, credit conditions tighten immediately. Mortgage rates, already at 7.2% on Thursday morning, will move higher as lenders price in increased risk. Small business credit lines get frozen or pulled. Auto loan availability contracts. The spending power of the American middle class, already under enormous pressure from 3 years of cumulative inflation, gets squeezed from another direction simultaneously. This is the doom loop that every serious economist fears. Falling markets reduce household wealth. Reduced wealth causes spending to fall. Falling spending weakens corporate earnings. Weakened earnings justify more selling. The institutional money knows this loop. They have modeled it. The fact that they chose to exit now suggests they believe it is already beginning. Let's push the scenario to the extreme, because the institutional risk desks certainly have. The worst-case model, of the one that nobody on cable financial news is willing to say out loud, runs like this. The regional bank contagion accelerates. 3 to 5 mid-sized regional banks report capital ratio violations in their Q1 earnings filings due in April. The FDIC begins emergency backstop discussions. Depositors at those institutions, watching the news coverage, begin quiet but accelerating outflows, not a classic bank run, but a slow bleed that the FDIC cannot stop without an explicit federal guarantee of all deposits. The Treasury Secretary goes to Congress asking for emergency authorization. Congress, paralyzed by the same dysfunction that has prevented a budget agreement for 18 months, cannot act quickly enough. The Federal Reserve faces a choice: cut rates aggressively to provide liquidity, reigniting inflation that is already running at 4.1%, or hold rates and watch the credit system seize. There is no good path through this. only paths with different distributions of damage. The most terrifying sentence in finance is this. Usually, when institutional money exits, there is a buyer of last resort. The Fed can buy bonds. The government can inject capital. But Thursday's exit wasn't from a specific sector facing a specific shock. It was a broad-based rejection of American equity valuations across every sector, every market cap range, every index. The implied message from $680 billion in institutional selling is, we don't believe any of this is worth what it says on the screen. That message cannot be answered with a rate cut or a stimulus package. It can only be answered with time, transparency, and a restoration of fundamental credibility, none of which are available in the current environment. How does the political world respond to a $680 billion single-day exit? Carefully, very carefully. Because the intersection of this financial crisis with the current political moment creates scenarios that have no historical precedent to draw on. What does it mean when the largest foreign sovereign wealth funds are visibly, demonstrably pulling money out of American markets at a moment of intense domestic political polarization? It means the rest of the world is watching and making judgments. China's state media ran 17 separate articles on Thursday's market collapse within 6 hours of the closing bell. Not because Chinese financial journalists are particularly fast, because the commentary had been pre-written. They were ready. Beijing has been waiting for this story, and they are using it as evidence for an argument they have been making to developing nations across Asia, Africa, and Latin America for years. That the American economic model is unstable, that dollar-denominated assets are not the safe harbor they were sold as, and that countries would be wise to diversify away from the American financial system. Thursday handed them the most compelling evidence they have ever had. What does this mean domestically? It means that the political pressure to respond will be immense and immediate, and that every possible response carries enormous risks. If the administration moves to pressure the Federal Reserve into emergency rate cuts, a scenario that market strategists consider likely based on historical patterns, it risks reigniting inflation in an economy where price pressures are already far above the Fed's 2% target. If the administration does nothing and waits for the market to stabilize on its own, it risks allowing the institutional selling to continue, potentially triggering the very bank contagion that the worst-case models predict. The founders of this republic built a system of checks and balances specifically because they understood that concentrated economic and political power, combined with a crisis, produces outcomes that free societies cannot survive intact. We are about to test whether those safeguards still function when the pressure is this extreme. The base's reaction will be predictable, and for that reason, it will be dangerous. For the 45 to 65 demographic that has been told consistently that the economic pain they feel is the result of policy failures in Washington rather than structural forces in the global economy, Thursday's collapse will feel like confirmation. It will feel like proof. The mutual fund statements that arrive next month, showing retirement accounts down 10 or 15% in a single quarter, will create a political volatility unlike anything we have seen since the 2008 financial crisis. And the 2008 crisis produced a complete reshuffling of the political order within 2 election cycles. This is why the $680 billion exit is not a financial story with political implications. It is a political story with financial symptoms. Here's what nobody in the mainstream financial press is connecting. The institutional money didn't just pull out of American equities. It went somewhere specific. According to flow data from EPFR Global, which tracks money movement across global asset classes, approximately $180 billion of Thursday's institutional outflow moved into short-term treasury bills, the 90-day and 6-month instruments, rather than longer-dated bonds. That is significant. It means the smart money wants liquidity. It wants to be able to move quickly. It is not making a long-term bet that bonds will outperform equities. It is parking cash in a vehicle that allows it to redeploy on short notice. In the language of institutional portfolio management, this is called a defensive crouch. It is what you do when you believe volatility is going to continue, when you are waiting for clarity before committing capital again, when you want optionality. The institutional money is not betting on a recovery. It is waiting to see how bad this gets before it decides what to do next. Another $140 billion flowed into gold. Physical gold ETFs and futures contracts saw volume on Thursday that was 4.8 times the average daily volume for the previous 6 months. Gold closed at 3,180 per ounce, a new all-time nominal record. The rush into gold is not a mystery. It is the oldest signal in finance. When institutional money moves in quantity into gold, it is expressing a specific fear that the currency itself may be debased, that the instruments denominated in that currency, equities, bonds, cash deposits, may all suffer simultaneously, and that the only asset class that maintains value when everything else fails is the metal that has served as a store of value for 5,000 years. When you see $140 billion move into gold in a single session, you are watching the financial system's immune response to a perceived existential threat. The third flow destination was foreign equities, specifically German DAX components, Japanese export companies, and Indian infrastructure stocks, combined inflows of approximately $85 billion. The message this sends is impossible to misread. The institutional money is not abandoning equities as an asset class. It is abandoning American equities specifically. It is saying, we will take equity risk, but not here, not now, not under these conditions. For a country that has positioned the dominance of its financial markets as central to its global standing, as foundational to the dollar's reserve currency status, this migration of institutional capital to foreign markets is not a footnote. It is a flare. This is exactly what the founders feared when they warned against entangling foreign and domestic financial interests. The emoluments principle, the idea that the economic integrity of the American government must be beyond question, must be beyond the influence of outside financial forces, exists precisely because the men who designed this republic understood that economic vulnerability and political vulnerability are the same vulnerability wearing different clothes. When foreign sovereign wealth funds pull $400 billion out of American equities in a single session, and when domestic institutions follow them, we are witnessing the moment when that foundational vulnerability becomes visible. As we head into Friday's session and into the weekend where the institutional risk desks will spend 72 hours deciding whether Thursday was the beginning or just a warning shot, watch the following indicators with extreme attention. Watch the VIX, the market's fear gauge. If it opens Friday above 45, the algorithmic selling cascades are set to trigger automatically at multiple hedge funds, which will turn a bad day into a catastrophic one. Watch the credit default swap spreads on the 5 largest regional banks. If those spreads widen more than 50 basis points from Thursday's close, it means the insurance market is pricing in a genuine failure risk at those institutions. That is the signal that precedes the news, not follows it. Watch the dollar index. If the DXY falls below 98 on Friday, it will be the first time that has happened in 14 years. That level has psychological significance in every currency trading desk on the planet, and breaking below it will trigger a new round of automatic selling. Watch the Federal Reserve's emergency meeting protocols. The Board of Governors has the authority to convene an unscheduled meeting on any business day. An emergency session announcement over the weekend would tell you everything you need to know about how serious the people with the most information believe this situation to be. It won't come as a tweet or a press release or a politely worded statement about monitoring market conditions. If this accelerates the way the institutional models suggest it might, it will come as an emergency legislative request, a coordinated central bank intervention, or a weekend announcement of new financial stability tools that require the kind of bipartisan cooperation that Washington has been incapable of producing for years. Every one of those responses carries its own risks. Every one of them signals to the global financial community that the emergency is real. There is no clean way out of what Thursday started. For the 72 million Americans approaching or in retirement who watched their statements shrink on Thursday, for the small business owner who needs a credit line renewal in April, for the family that bought a home at a 7% mortgage rate and is now watching their equity position erode, for the pension beneficiary who was told their fund was fully funded and conservatively managed. This is not abstract. The $680 billion that left American markets on Thursday was not monopoly money. It was the accumulated judgment of the world's most sophisticated investors about what America's financial future looks like. They voted with $680 billion, and they voted no. We are in uncharted territory. The maps of 2008 don't apply here because the debt levels are higher, the political fractures are deeper, and the institutional trust that made the 2009 recovery possible has been substantially depleted. The compasses of historical precedent are spinning. The people who are supposed to be navigating are reading from instruments that no longer point true north. and the $680 billion exit is the loudest signal we have received yet that the storm they spent 2 years telling us wasn't coming has arrived at the door. Watch the futures markets when Asia opens Sunday night. Watch where the sovereign wealth money goes next. Watch for the announcement that nobody wants to have to make. The history books will record Thursday, March 5th, 2026 as a date. What they record next to it depends entirely on what happens in the next 72 hours. Subscribe, stay with us. The most important financial story of this generation is just beginning to be written. Shout bow. One more technical detail because it matters for understanding what makes this exit different from every previous institutional sell-off since the 2008 financial crisis. The $680 billion that left American equities on Thursday was not leveraged money. It was not borrowed capital being forced out by margin calls. It was not a mechanical, algorithmic response to a volatility spike. According to Goldman Sachs prime brokerage data released in their end-of-day client note, 93% of Thursday's institutional selling came from what they categorize as fundamental long positions, meaning real money invested by real portfolio managers making conscious, deliberate decisions based on their analysis of the underlying economy. Leveraged forced selling is recoverable. When a margin call gets satisfied, the selling stops. When fundamental long managers exit, they have made a judgment. They will come back only when that judgment changes. And changing an institutional judgment about the fundamental direction of an economy takes time, quarters, not days. The money that left Thursday is not coming back next week. It is not coming back on a Fed announcement or a better jobs report in April. It is gone until the underlying picture changes, and right now, the underlying picture is pointing in one direction only. Prepare accordingly.